Okay, so we're going to go through this again. I found what was throwing things off is that when I was constructing my key in Excel, um, I used 30%, not 1/3. So if you would scratch that piece out, 30%, and my numbers work. So I apologize for that confusion. Let's take it from the beginning. I give you an adjusted trial balance, meaning that we have all the revenues and expenses recorded for the period, even those that were non-cash based that we had to make adjustments for. So that means we have particular accounts down here in our income statement accounts that would only appear on an adjusted trial balance, like depreciation expense, tax expense. Some of the others could appear without having to be an adjustment, but those two in particular, those are estimates based on things that only happen in adjustments ever. Also, this guy would be one as well. But anyway, so we're going to be focusing on this portion because we're just really worried about constructing this income statement first. Remember, that's the first financial statement we always do. We're not going to include dividends because dividends are not a not an income statement item. So really, we're just down here between sales revenue and tax expense. Now, in order to lay it out, we're going to go through what this company would be without the decision to discontinue. So if we do not discontinue, then we're building the income statement as normal. So we decide not to discontinue, then what do we have going? So we always start with sales revenue. And you might want to have the sheet next to you just to see exactly what numbers I'm pulling because it's hard for me to flip back and forth on this limited view camera. So we start with our sales revenue. The sales revenue reported on the trial balance is 170. The cost of goods sold reported is 75. And we take the difference but those. That's our first subtotal, gross profit. And we have 95. Now, SG&A, remember, SG&A is going to be comprised, I will flip back here, of all of our operating expenses that are not separately disclosed. So first, remember, operating expenses are the everyday expenses that keep the company in motion, that drive profits. So what are all of the operating expenses? Depreciation expense is an operating expense because we use machinery, equipment, buildings in our everyday operations. That is their expense. Wages, obviously, we're not running our company without employees. Research and development, this is a operating expense, especially for, say, a tech, pharma, anything in the scientific pursuits that is trying to put out some new innovative product. Utilities expense, that's an operating expense. Got to keep the lights on, got to keep the water running. Insurance expense, got to make sure we're covered for incidentals and issues that happen at the workplace and to our customers. So now we have these operating expenses. Now, some of these are separately disclosed, right? Depreciation expense is separately disclosed for Wall Street tycoons who like to back out depreciation when they're assessing earnings. They add it back. So that's not going to be SG&A. Research and development is also separately disclosed because investors like to see what's going on in terms of the costs that are being incurred to develop new products, new IP. So those two are separately disclosed. Wage expense, utilities expense, insurance expense, these are not. These belong in the SGA category. So remember, everything, basically, everything, oops, sorry, wrong, not that. Everything that is outside of some special line item. And really, I highlighted the most common ones: restructuring, R&D, impairment of continuing assets, and depreciation. Everything outside of those typically gets lumped into SG&A. So we have wage expense of 58, utility expense of 5, and insurance expense of 3 going into our SG&A number, which comes out to 66. So we report our SG&A. Typically, it's the most prominent right after gross profit that the company will just disclose all of its SG&A. And then we include those other operating expenses that get separately disclosed. Depreciation is 13. R&D is 10. So now we're up to all these are the operating expenses. There's no other ones. So now we have another subtotal because we have now incorporated all the operating items, including these two. That would be income from operations. And that's $6. Now, we're done with the operating. We go to the non-operating. The non-operating items from this were the interest expense, the ones that we haven't flagged yet, the interest revenue, and the unrealized gain on trading securities. So those three are outside of operating items. They're not our normal profit drivers. So we take that interest expense, which was 5, the unrealized gain, because we haven't sold them yet. We're still holding on to those investments. That was 8. And this is the interest revenue we've received from others, borrowing our money. And oops, sorry, should not be negative. That's a revenue. So we take 6, subtract 5, add 8, add 6. That brings me up to 15. And that is my pre-tax income. So now we have to apply a tax expense. The tax expense is already given to us at $3, or 3,000 in this case. These were listed in thousands. Then we have tax expense of 3, which leaves me with net income of 12. Now, the tax expense was given to you. You weren't given a tax rate. However, we can determine the tax rate really easily because pre-tax income multiplied by the tax rate is going to give me the amount of tax that I'm recording. That is just a simple formula refresher from what we were doing in the adjusting entry issues. So take that pre-tax number, 15, multiply it by a number. Solving for x gives me 3. And then if you do the math, you'll find that x is 0.2 or 20%. That's going to be necessary because when we break the company apart, it will come to a different pre-tax income, and we're going to have to know the amount of tax to apply to it. All right, so now this is where it fell apart the other day, and it won't today. So I promise. Now, if we decide to discontinue, then we are breaking the company into 2 pieces. We are taking the discontinued portion out. So I'll call it the discontinued division. And we are going to go under that assumption that 30% of all these items except for the unrealized gain, which is entirely a part of the continuing operations, is the discontinued division. So 30% of everything except for that, then that's the discontinued division. So in sales revenue, we have 51. And all of these are classified the same accounts, just different numbers. Cost of goods sold becomes 22.5, which gives me 28.5 gross profit. The SG&A times 30% is 19.8. The depreciation comes to 3.9. The R&D comes to 3. I add these up again. It should just be 30% of 6, which it is. When I take 28 less these 3, 1.8. So that's my new income from operations for the discontinued division. Now we get into the non-operating items. Interest expense is 1.5. The unrealized gain, remember, is not a part of the discontinued division at all, not even 30%. It's just 0. The interest revenue is 1.8. So I take 1.8, subtract 1.5, and add 1.8. I almost try to subtract that again. Add 1.8 gives me 2.1. This is where we start to differ, because we're not just taking 30% of all of these items. We didn't take 30% of that. So now 2.1 is not 30% of pre-tax income. And we can't take 30% of the tax expense, because now these two numbers are off. So what is 2.1 times 20%? And that's why we needed this number. That's 0.42. And I take the difference. That gives me net income, net of tax, in the discontinued division of 1.68. So what would the formal disclosure of the income statement look like? This would be the reported income statement for company with the decision to discontinue. Now, oops, I forgot a D. Reported income statement for the company. Now, what we're going to do is just take the difference here, up here, right? Because if this is the amount of sales revenue that's due to the discontinued division, then with the decision not to discontinue, we just take the difference. The amount that's remaining of 170 after we subtract 51 is what the sales revenue for the ongoing operations of the company are, the continuing operations. So that difference is 119, and we just keep taking that down. 52.5 is remaining of cost of goods sold. That's the cost of goods sold for the continuing operations, which gives me a gross profit of, take the difference, 66.5. And then we continue to take those differences. 19.8 of SG&A was the discontinued, which leaves 46.2 for the continuing operations. Same process for depreciation, leaving 9.1 for continuing operations. For R&D, it's 7. And then take 66.5, subtract these 3 operating expense categories. It brings me down to income from operations for the continuing operations of 4.2. Now we incorporate those non-operating income items. Interest expense comes down to 3.5 for the continuing ops. The unrealized gain, remember, is totally a part of the continuing operations. So all 8 of that gets reported. The difference here brings me to 4.2. And every time it's revenue, it's revenue, it's revenue. Okay, so take 4.2, subtract 3.5, add 8, add 4.2. That gives me my pre-tax income for continuing operations of 12.9. Now, this pre-tax income, of course, we're going to apply this tax rate of 20%. That gets me a tax expense of 2.58 and a result of 10.32. So this would be the net income of the continuing operations. So remember, all of these items that we listed here are only the continuing operations. Right? We took out all of these items that were a part of the discontinued division. And of course, note that in the end, when I include everything, 10.32 plus 1.68 is net income of 12. But here we have only the continuing operations. So this is no longer net income. It's not income for the entire company with everything considered because these things were taken out. So we call this income from continuing operations. This is what replaces net income in that progression of subtotals: gross profit, income from operations, pre-tax, not net now, it's income from continuing operations. In order to make it net income, we have to include the effect of the discontinued division. And the way that that gets disclosed on the income statement is to report the income or loss from discontinued operations. Now, we've had income this time, right? It's positive 1.68. We could have had a loss. And if it's a loss, you just subtract it, right? But since this is income, we need to make sure that we also net tax from it, which we did. We took the tax expense here to get down here. And it's important that we not give it at the pre-tax value, because then we're forgetting some tax expense, because this tax expense here was only for the continuing operations. It did not net out discontinued operations. And so we report 1.68. That's our income from discontinued operations, net of tax. And that leaves me with now net income of 12. So that is how we would report the entire company with the decision to discontinue, right? All of these items don't change. The only thing we do is we take all of the pieces of the discontinued operations, run a mini income statement on them, get down to their net income individually, and then swing it into the very end of the income statement. And again, remember, the income statement is about persistence. And so these disc ops, they are not going to be persistent. They're not going to go into the future. So the company puts them low on the income statement.